The first way that you can finance a business acquisition is using your own personal funds and savings. So you can use your own money. You don't have to borrow anything if you're wealthy enough. And then there's some disadvantages, there's some advantages, and we're going to talk about what those look like. Of course, the advantages, the first one that's front and center is full ownership. By using your own funds, you avoid taking on any debt or giving away any equity. This allows you to retain full ownership and control of the business. You don't have any interest or loan payments. You don't have to worry about interest rates, monthly loan payments, or meeting lender requirements, which can reduce financial pressure during the early stages of business ownership. Faster closing. Since you don't need to secure approval from a lender, the transaction process can move so much more quickly. And then there's two disadvantages here. One is risking personal capital. Using your own savings means putting a significant portion of your personal wealth at risk. You could face substantial financial losses if the business doesn't perform as expected. And then limited growth capital. Tying up your personal funds in the purchase may limit your ability to invest in the growing of the business, hiring new employees, or expanding operations in their early years. So you don't have any leverage, and to you that might be a really good thing or it might be a bad thing. The next option is using the SBA to finance the business. And I put a lot of text on this slide because it's really important to hear me say it and also be able to read through it because there's a lot here worth knowing. So the SBA is a small business administration and they offer loans to entrepreneurs. The SBA offers several loan programs that help buyers purchase a small business by guaranteeing a portion of the loan, which reduces the risk for lenders. The most common loan used is known as the 7A SBA loan, and it's very popular for business acquisitions. And this allows borrowers to finance up to $5 million of a purchase of a business. The terms, SBA 7A loans are typically offered at up to 10 years of repayment, and they have lower interest rates than conventional loans. So that's fantastic. A 10-year loan at lower interest rates, I'll take it. Requirements. To qualify, you must demonstrate good credit, have a solid business plan, and have some form of collateral. The SBA will want to see the business has a strong financial track record. Down payment. Most SBA loans require a down payment of 10 to 20% of the equity purchase price, so you'll need to find some sort of personal funds to qualify. And there's still some flexibility there we'll talk about later, but it's so valuable to be able to buy a business for just 10% of the purchase price initially. And you get a lot of debt, you get a lot of leverage, but you also get the asset. Conventional financing is a third option. If you aren't interested or don't qualify for an SBA loan or prefer more straightforward lending process, you can get a conventional loan from a bank, a credit union, or online lenders. There are collateral requirements, of course. Conventional lending has substantial collateral requirements to secure the loan, and they're going to want to have a lien on the business assets, your personal assets, or a combination of both. And you're going to pay at market or a higher interest rate for these types of loans. Interest rates on conventional loans are typically higher than SBA loans, and repayment terms may be shorter. There are other financing options that you can pursue as well. There are lines of credit. A business line of credit allows you to borrow funds as needed up to a pre-approved limit, which can be helpful if you need flexible financing for operational growth or expenses. And then personal loans. If the business is relatively small and the purchase price is modest, you may be able to get a personal loan to finance all or part of the acquisition.